video, we will learn the definition GDP. Although the definition is pretty straightforward, we're actually going to spend a few minutes to explain the definition in details. So please don't ignore a very important information you can find from this definition. And so if you ignore them, it's very easy to make mistakes. So before we look at the definition for GDP, I want to remind you again, the GDP is created to measure the performance of one economy. So if you're an economist, if you try to think about a way to measure one economy, whether they are growing or decreasing, so the number one measurement you can think about is to measure how many products they produced. And so how can we measure it? So we definitely can using the physical term to measure it, such as this year or last year we produced 3 million tons of orange, 3 million tons of bicycle, or 3 million units of the bicycles, and 7 tons of rock. And this year we produced 4 billion tons of orange, 4 million bicycles, and 600 tons rock. So now my question is, do you think the economy get better or get worse? So you might say, I don't know. If you want to ask me, I don't know either. So what's the problem? So the problem is, so every product is measured on a different unit, and it is hard to compare across in years. So in order to using a way to measure the economy crossing different year or even crossing different countries, and people realize that we have to use the same unit to measure different outputs. So the best way to measure it actually is the price. So no matter is the product or services, when people have exchanging the product or services or from product to services, people always need to pay a price. And actually the price is the measurement to measure the value of the output. So in the US, the price is measured by the dollars. And so the product is more expensive. That means they're more valuable. So that's why when we define the definition of the GDP, and you will find actually we are using the dollar to measure the economy. So now let's look at what is the definition for GDP. So I remember in the introduction video I asked you what's GDP stands for. So now you should know what GDP stands for. So GDP stands for Gross Domestic Product. So the definition for GDP is that the total dollar value, which is emphasized, is not physical items. So it is literally measured by the dollars. So it is the total dollar value of all final output produced within a nation's border in a given time period, and usually 1 year. So you can see in this definition, it's pretty straightforward. And however, I emphasize 3 very important phrases. All final output, this is our first phrase. Second, produce within a nation's borders. Third, usually 1 year. So let me explain the third phrase first. So why we need to mention about usually 1 year. So keep in mind, so GDP is created to use to measure the economy, and we want to use this index to understand if our economy getting better or getting worse. So if we don't use the same amount of period of time to measure the economy, when you try to compare, it's very hard. So for instance, you compare the total value of the output within a month compare with the total output value within a year. So it's kind of unfair comparison because one is only using the value within a month, another is using the value within a year. So there is no doubt the value for a year is larger than the value for a month. So to be fair and to be easy to compare, and people will usually try to calculate the value of the product given a given time period. So by default, we choose 1 year because if you think about try to figure out the value of the output for a country and to do daily, time consuming, and it's not valuable, or weekly, and you're going to think about we have the seasonal impacts. So summer, winter usually have different product will be sold, and people's shopping behavior are totally different. So we have to consider all the information. So that's why I usually consider as a year. So within a year, how many product produced? So what are their what values? So after you understand the third important phrase, usually 1 year, so I will spend a little bit of time about the first and the second phrase. All final outputs. So why we only care about the dollar value of the all final output? So in order to mention about final good output, I have to introduce a pair of the concept, intermediate goods and the final goods. So I want to give you a definition for intermediate goods. So intermediate goods usually purchased by producers. So they were produced to be used to make the final goods and the final services. And so the final goods usually be purchased by the consumers, and they are directly consumed by the consumers. So look at the charts, these two pictures. So the first one on the right picture is a concrete. The one on the right is a sheep. So look at these two pictures. So which one going to be my intermediate goods and which one going to be my final goods? Yes, you're right. So the left one will be of intermediate good because producer will purchase this product. They are using the concrete to make buildings or make a boat or make the final goods. And so the consumer will not purchase the concrete. It's the producer will purchase the concrete. And obviously the picture on the right, the sheep will be our final goods. So the consumer purchase it and use it and as a transportation. And also they can have all kinds of services on the boat. So this will be final goods. So why in our calculation for GDP we only consider the value of the final goods? How about intermediate goods? So to answer this question, I want you to look at the next slide. So this is about making a bread. So we try to understand what's the value for a loaf of bread. So there's a couple of different ways to calculate it. So first, in order to make the bread, you need the flours and you need the labors and all kind of other ingredients. But for flours, it's originally coming from wheat. So on this slide, you can see the wheat you're gonna use to make flours. That flour can be used to make a loaf of bread. It's worth 80 cents. And the flour used to make a loaf of the bread worth $1. And the labor and other material cost $2. And at the end, you see in the bakery shop, the loaf of the bread, it costs $3. So now I want to ask you to calculate what's the value of my output. Do you want to use the first method, 80 cents plus $1 plus $3 equal to $4.8? Or you only looking at the value of the loaf of the bread, $3? Or you are considering use 80 cents plus how much value you gained from the wheat to flour, 20 cents, and plus the labor and other material, $2, and you end up $3. So if you're using the first method to calculate it, and you are totally wrong. You have to keep in mind that the loaf of bread, that $3, it is not just decided by the owner, so he's the one who charged $3. So that $3 is including all the value of the intermediate goods, the labors, and other things. So if you add all the intermediate goods value, and also your final goods together, you actually double counting the values. So you overestimate the value of your output. So now you look at second and third method. So they all give you $3. Does that happen by coincidence? So the answer is no. So what happened? So the third method, 80 cents plus 20 cents plus $2, it also ends up $3, is because you will find that the final goods value also equal to the intermediate goods value plus value added or added value. So you also end up the final goods value. So obviously compare third method with the second method, and you will know that only consider final goods value is much easier, especially if you are trying to think about the whole country's output value. If you are using the third method, intermediate goods value plus added value, and you will put yourself in a really troubling situation. So to make life easier, so when people considering the value of the output, so they will only use the final goods value. So final goods value. So to do a short summary about what we just learned about the first phrase in our GDP definition, the value of the final goods. So you have to understand the following concept. What is the intermediate goods? So the goods and or service purchased or for use as an input in the production of the final goods or in services. And the second definition, value added. So this is the increase in the market value of the product that takes place at each stage of the production. Just like what we see here, from wheat to flour, the value add 20 cents. From the flour to bread, the value added is $2. So you have to understand, if you only consider final goods value, it's also equal to the intermediate goods value plus value added. And so you can see why we only consider final goods instead of all goods, because we try to avoid the double counting problem. So now let's look at our definition again. So we understand why we only consider all final output. Let's move on to the second important phrase, within a nation's border. So what does that mean? So what is within a nation's border? So the GDP is graphically focused. So we only focus on the output, the final goods produced within a nation's border. So what does this mean? So that means, for instance, there is a Chinese businessman. If he or she opened a factory in US, such as they are making cars in US, so the product they made here actually contribute to the US GDP, although the owner is from China. And so since we talk about GDP, we have talked about the very similar definition. It's called the GNP. So GNP stands for Gross National Product. So this refers to output produced by American-owned factories, regardless of the location. So this is a total different definition in terms of what is the limit. So actually for GNP, it's including the final goods that produced by the American owner, no matter where the factory located. So for instance, Apple opened a factory in China, and they produced the iPhone in China. So the iPhone produced in China will contribute to the US GNP, but not US GDP. And so why people think GDP is better than GNP? So think about, for the factory run by the Chinese businessman, and so they open a factory in US. That means not only just because the output they produce here, but most importantly, they open a factory here, they will hire more people working for the factory, because they will not import the labor from China. If that's the case, they should open a factory in US. So the GDP is a more healthy way to measure how good the economy is performing, because when they do the calculation, they have more preference on how the production going to affect one economy. On the contrary, for GNP, they are only consider which own the company. So if it's owned by the US, and then that whatever they produce, the final good they produce will contribute to the GNP. So that's actually give more incentive for the business to open a factory in another country, and so which will not benefit the employment rate. So keep in mind, for GDP, when we are defining GDP, we emphasize it is the product produced within a nation's border. So we don't care who owns the factory. We only care they are located in the own nation. So to summarize what we just learned about definition of the GDP, so it is total dollar value. So first of all, it's not physical item. So we talk about the dollar value. Second, and it has to be the final goods. Third, the final goods has to produce within a nation border. So it doesn't matter who owns the factory. And fourth, when we calculate GDP, we always talk about within a certain period of time, a fixed period of time. And then by default, we choose 1 year. So after this video, you should have really good understanding about what's GDP, how it is calculated. And so in next video, we actually going to spend some time to look at what kind of the problem the GDP will have.